Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the desk at the Nasdaq market site, we have Michael Sokoll, AVP on Nasdaq's market intelligence desk, as well as Max Cabasso, managing director on Nasdaq's market intelligence desk. We are going to discuss how the market is actually interpreting good news as good news. Mike, it certainly is a reversal of what we've seen, where certainly in the beginning of July, where good data that was coming out was perceived as bad for the market because, the perception of less rate cuts. Seems like it switched because the digestion of the consumer and inflation data, jobs data, GDP print today, it's been well received.
Yeah, I think a couple of things. I think we're back to the future in a little ways. November, December was all about small cap outperformance, and we're back to what we saw a lot in 2023, where you have the much bigger companies and the growthier companies that are doing the outperformance. I think the market, to start the year, stumbled a little bit. They were like, oh, we're not going to get as many rate hikes as we thought. Rate cuts as we thought. And then of late, it's been more about, well, you know what? We can live with that so long as the economy holds together, and maybe we're going to get better earnings.
Right. Max, in my mind, I'd rather have a stronger economy, everybody working, consumer spending, earnings are good. That's great for corporate balance sheets. Versus, okay, none of that is doing well, but we got a 25 basis point rate cut.
Yeah, I think we've turned that corner now that the market and the economy can handle these rates. Now, it might not be ideal, and maybe we'd be, going gangbusters right now if the rates weren't where they're at. But the volatility of the rate moves has kind of tamped down. It's more consistent. So again, we're able to digest it. Companies are managing better, managing through the cycle now. Okay, we know where we're at. We're still chugging along with rates where we are right now. Maybe we don't need that rate cut to kind of spur the economy going and say, okay, you know what, good news might actually be good news because companies are going to perform well. Again, the jobless claims are a little bit higher than the survey, but again, digesting it to say, okay, maybe we don't need that to continue to move higher, have the market continue to go higher. A little bit stretched at this point, but again, it's better to see that. Again, I'd rather have the strong market, the strong economy versus we need the Fed to backstop us every time there's a hiccup. I'd rather have the market actually do the work versus the Fed and fiscal policy.
I mean, that's a great point that you make. And Mike, let's lift the curtain back here a little bit. In the markets intelligence desk, you talk to our listed companies all day long. You're talking to the treasurers, their investor relations experts, and so forth. What are you hearing from Nasdaq listed companies in terms of how they're perceiving the economy and their impact to the balance sheet?
Yeah, I think one of the things to point out is the S&P's hitting records, so is the Dow. The Russell's still 20% away from the records. So there's a lot of small cap companies that are still saying, hey, what about us? What about us? So we have to keep in mind that you need some outperformance and hopefully get some earnings growth from those companies too. The S&P is looking at 12% for next year. The Russell 2000 is only at a 22 PE versus the S&P's 20. So what you really want is those smaller companies to say, okay, lower rates are good. We can refinance ourselves at these somewhat lower rates compared to at least what we were facing. And that's good for our companies, and therefore that can translate into better margins, better earnings, and then ultimately better stock prices.
It sounds as if they have a little bit more clarity too. I mean, when we had interest rates going up the way they did over the course of 9 months, I mean, that had to be a little bit, mind spinning for them.
Yeah, that 10 years holding in around 4.15%, and then that's what you need is a little stability, like you said.
Right. Let's talk about that for a moment here. And we covered this yesterday, where at the end of the year we saw small caps far outperforming large caps. That kind of reverse course of the first 3 weeks of the year. But today we're seeing a slight outperformance with the small caps versus the large caps. It doesn't sound, well, to your point that you just made, it doesn't sound like fundamentally that much has changed.
Yeah, I think we pulled a lot of good news on rates into the end of last year, and so there's a little bit of unwind of that. But to everything you said at the beginning, the economic data seems solid enough where people are saying, all right, now we're discounting a better economy, better chance of no recession, soft landing, and you know what? If you still give us 3 rate cuts on top of that, that's a good formula.
Yeah, well, it seems like 6 rate cuts is a little bit aggressive.
Yeah, I think the market got a bit ahead of themselves, and the Fed kind of said that was a bit much. But again, I think we always looked at the MOVE index last year of how much rates were moving and the volatility of it, and that's kind of what I've seen with some of the smaller companies. When everything was going kind of haywire, I guess you could say, it was tough to forecast, it's tough to plan because you didn't know where rates were going to settle. You didn't know how it was going to play out. Is this going to bring inflation down? So it was tough for them to kind of forecast out 12, 24, 36 months, how everything's going to look, how are we going to do financing. Now again, it might not be ideal for them having rates kind of where they are, but they can at least plan for it and budget it and factor that in, knowing it's more consistent. Okay, we're probably, even if you factor in 3 cuts, you have an idea of where they're going to be, and it's not so much of a guessing game. So, okay, now we can plan for it. I think earnings and some of the calls and guidance for some of the small caps will be important. what do they come out with? Now they have that kind of firm handle on where rates are going to be. What do they think that's going to do for them? They can actually say what they're expecting, knowing where rates are. All right, we're going to refinance, we're going to take on debt, whatever it might be, and what that's going to cost them to project out further what they're going to do. So there's less uncertainty there. So maybe that's where you start to see some of the outperformance potentially with some of the small caps catching up is, there's less uncertainty. Okay, now I feel more comfortable to get back into that space and invest in some of those smaller companies that don't have as many question marks, as more, because again, it's been strong outperformance for the large caps or small caps, but again, without that uncertainty, potentially they start to close that gap a bit.
Right, and a quick note on earnings before we get into the charts here. They've been quite good for the larger names that have performed, with the exception of Tesla and Humana last night.
Yep.
Everyone beat,
yeah,
and beat pretty decently.
It's been a good start. Tech has really been off to a strong start. Right. Again, it's still early, like we talked about yesterday, but it's a good start. Banks did okay, but again, tech has been a good start. The chips space, semis, really strong. So again, pricing in some of those stocks is getting a little bit extended, in that space, but that doesn't mean anything's going to pull back. And again, if we continue to see strong prints, you're not going to see a sell-off there. So that could definitely, continue. Again, it's really important now, and that's kind of where we like it to be. But
well, it's nice to get back to fundamentals for a change,
yeah,
right? Not just talk about what's happening in the macro. Let's look at some charts, though, because, of course, what happens with the prices is what confirms our thesis here. Our first one here, again, looking at the divergence of the performance with the large caps and the small caps. Yeah, so this was from today. We opened up this morning with small caps really above where S&P was. This is Russell versus the S&P. S&P's kind of gone flat for the day. We're again 30 basis points higher. The IWM, which is Russell, is up at 55, but the morning we saw a really big move. Now again, I think potentially some of that is a bit of a short squeeze. Shorts are a bit heavier on some of the small caps, so some of that getting taken off. They gave it back, inverted a bit, but has since kind of expanded out. Again, it's outperformance by about 30 basis points. And we look at, this is year to date, that gap is still pretty wide, right? Your S&P is up almost 2.5%, and the Russell's still down 2.5%. So there's a 5% gap there. And again, we're not even done with January yet. So that gap is there, but as we saw this morning, start to close. And again, potentially with how some of these earnings prints come out, if there's underperformance essentially in large cap, and you see decent prints from small caps, you could potentially see that gap close. But it's going to be tough, but we did see it this morning, and that's been rare. Yeah. So it's definitely a difference than what we've seen. Well, it is interesting, Mike. I feel like January's been off to kind of a weird start, if you will. The volumes are a little bit off. Everyone's just so focused on the macro. Now we're starting to think about earnings. It feels as if January's just been off to kind of like a unique start. Yeah, I think a couple of things. One is, no matter how earnings plays out, I think you're going to be 1 or 2 percentage points on either side of flat for all of last year's earnings. So the real story is what happens in 2024. Do you get that 12% growth that you expected? That's really the thing. And S&P is still far outperforming, the Russell, as noted. The Magnificent Seven, just since last January, has added like 1.8 trillion in market cap, which is 2/3 of the value of the entire Russell 2000. Right. So you really need those guys to catch up a bit and broaden out this rally for the market really to be healthy. Right, and we were talking about this off camera. A lot of that was attributed to the AI story, right? Yeah. I feel like whether it's the Mag 7 or virtually every company has an AI story attached to it now. Now we need to start seeing AR, right? Annual recurring revenue. We need to start seeing products. We need to see revenue being derived. Like, the story's cute, but now the underlying has to match the multiples that have been awarded to these companies. Yeah, the gap off of the Russell 2000 off its high is about 20%. And that divergence is the greatest, I think, since the year 2000 compared to the S&P, which is hitting a high, so's the Dow. So it just seems a little bit weird, I guess, right, that you have those large cap focused indexes at such highs and the smaller ones not performing. You can make a pretty good argument, but you could have made this last year, that small caps could close that gap. Yeah. The question is, I feel like small caps, and we were talking about this, it's like being ready, set, go. And like, there's just no follow through. Yeah, sometimes there hasn't been any follow through. But back to the AI thing, I think the Mag 7 and some of the large caps have benefited the most from that AI hype cycle, from that narrative. Potentially, that could be where it closes a bit. If that doesn't start to show up on the balance sheet, like, okay, yes, it's a story. If they don't actually start showing those earnings, those multiples are going to contract, and I would think pretty quickly. So again, that show me story is now. I didn't think it would be that quick. I mean, we talked about it, a few months ago, but it's happening a lot faster than anticipated. So again, those multiples have really expanded because of the AI
story, but now it's time to put up. And,
I mean,
and show
every
those
technology evolves quicker and quicker
Yep.
each time. Let's take a look at the VIX. We haven't spoken about that in a while. I would imagine it'd be relatively muted based on the move that we've seen over the past couple of trading sessions.
Yeah, I mean, we ticked up above 14, last week, 2 weeks ago. Thought that might have been the start of something. We had that kind of week rally, week sell off, week rally, week sell. We're still under 14.
Right.
I mean, it's really quiet. I would anticipate that would pick up into earnings one way or the other. But again, we've been sitting here at these levels for a while. Again, end of the year picked up, but then we saw that, with the rates expectations coming off, VIX cratered again. We're back down below 15, 16, so we're 14. It's really sanguine. There's not much happening. There's still been a lot of options volume, but it seems to be more in individual names than, kind of broader. So
You had pointed that out.
yeah, it's tough to find anything here again because it's been kind of that steady one way or the other. We see these little pickups, but again, we didn't even crack 15, when we started to sell off in January. So it's been very quiet and it's been pretty consistent. I mean, outside of a few periods where we ticked up, I mean, this is very low.
Yeah.
So I wouldn't be surprised to see it pick up, as we get further into earnings.
All right, last minute here. Let's talk about oil for a moment, right? $76. Demand expectations are higher, of course, with the U.S. economic growth. You have China's stimulus, supply remains tight. You have, of course, winter storms sometimes hit crude production. So we've seen a little bit of an uptick here.
Yeah, I mean, look, we started off down, at $70 in the month, and we've started to, have since started to rally. Again, now we're up at, 77. Yeah, we'll see if we can get back above 80 or if it gets there. But again, it kind of goes back to the strong market, the strong economy. People are going to be spending. Personal consumption was up. People are still spending. People are still traveling. I know some of the airlines had come out and said they expect their fees to basically stay the same. So airline expenses are kind of going down. So again, people are going to be willing to travel. They have that money. Haven't burned through it like we kind of expected last year, where all the talk about recession, it's coming, hasn't materialized. The consumer is still there, so that demand you would expect to continue to pick up into the later winter. We'll see also what happens in the Middle East, which again can throw a wrench into things. If that picks up, I wouldn't be surprised to see oil tick up even higher if there's now some issues with supply, not just the demand side. So, I think it's a decent setup here. Again, we bottomed near $70, and that's kind of been the lows here. So we'll see if we get back above 80, but there's definitely some tailwinds behind oil.
All right, Michael, and last word here as we go into the next 4 or 5 weeks where it really gets heavy into earnings season. Any trends that you're going to be looking for specifically?
Yeah, I think it's a continuation of the earnings season. We've gotten out of the gate, a little bit actually negative if you put all the companies in the mix there. And so the question is, can we turn that, start getting those beat rates a little bit higher than what we've been seeing? And does the rally broaden out? We're seeing the S&P 500 report, but as you proceed through, you're going to get some of the Russell 2000 and other smaller cap companies reporting, and particularly with the forward-looking guidance, that's what we'll be looking for.
All right, gentlemen, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me from the market site. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.